Okay, well, good afternoon, ladies and gentlemen. My name's Stephen Fletcher. I'm Head of Retail Distribution at GSFM. And on behalf of all the team at GSFM and also Munro Partners, welcome to the webinar today with Munro's co-founder and also CIO, Nick Griffin. Look, first of all, I just want to say sorry we couldn't be with you in person today. We would love to be in each of the states catching up with you all face to face. However, as a result of the uncertainty with COVID, we've just made the decision to continue to provide you updates via Zoom until such a time where we can get on a plane and visit you in the capital cities. Hopefully that's not far away, and you know, in the next quarter or two, hopefully we can catch up with you then. I'd also just like to start by thanking you all very much for your terrific support. The Munro Global Growth Fund in Australia went through $1 billion just on Christmas in funds under management across 3 of the separate vehicles. And again, just on behalf of all the team at GSFM and Munro, thank you very much. It was a very, very strong year for us in inflows in 2020. And you know, we're looking forward to working with you again throughout 2021. Now, the 3 vehicles that I mentioned, first of all, we have the flagship fund. The one that most of you know is the Absolute Return Fund, the long-short vehicle. We also have an ASX quoted Munro Global Growth Fund with a stock code MAET. And we launched this early November last year. And this vehicle's for those investors who prefer to access Munro via the ASX. So you can now do that also. And then the 3rd vehicle is the Munro Concentrated Global Growth Fund, which effectively adheres to the same investment process, however, provides investors with a growth-styled, concentrated, currency unhedged, fully invested global equity offering. Now, all 3 of these vehicles have recommended ratings and really are just designed to give investors access to Munro's stock picking capability in a format that best suits them. So the GSFM team around the country can take you through any or all of these offerings should you wish to know more. Now, like me, I'm sure that you're all very, very happy to say goodbye to 2020. I know I certainly was. I think, first of all, from a health perspective, but in the context of today's discussion, you know, with financial markets, it was certainly a roller coaster ride for investors last year. For the Munro Global Growth Fund, with its absolute return focus, as you all know, it's all about preserving capital first and generating positive absolute return second. And that's really how 2020 played out for the fund in the calendar year last year. The risk management tools that Munro have fine-tuned over many years now were in place and did a terrific job during that aggressive sell-off in March. And when you combine this downside protection with the strong stock selection throughout 2020, the Munro Global Growth Fund had a very, very strong year. It returned 40.6% in calendar year 2020. So that effectively now means that it's delivered 17.8% since inception. So the question now is, and that's why we're all here today to hear from Nick, is to where do we go to in 2021? And based on the year so far, I think risk management will certainly continue to be a really important focus for all investors, and I know it is for Munro. And that is one question that I'll certainly be throwing to Nick shortly. As we get into the webinar, the format for today is a Q&A style. So effectively, we've put together a whole range of questions that we're getting from advisors out on the road. And I'm going to ask those questions of Nick today. Then after the formal part of the Q&A session, we're then going to go to your questions. So please ask as many questions as you like throughout the presentation in the box provided at the bottom of your screen. And we'll aim to get through as many of these questions as we can. So as I said earlier, I'm very pleased to be joined by Nick Griffin. Nick is a co-founder at Munro. He's also the Chief Investment Officer. So Nick, before we get going, first of all, welcome to you.
Yeah, thanks, Steve. Thanks for having me.
Pleasure. Now, Nick, before we get into the Q&A, maybe if I hand over to you just for a quick 5-minute update, you know, a Munro business update, and then after that we can get stuck into the Q&A. So with that, I'll hand over to you.
Yeah, thanks, Dave. And look, hopefully you can all see the screen in front of you. And as I said, we do want to keep this as interactive as possible. But in the next 5 to 10 minutes, I'll just give you a very short introduction. A lot of people would have seen some of this stuff before, but some of you hadn't. And so, and I'd encourage you, if you want to know more information about what we do and how we do it, to go to our website. But just very briefly, so Munro Partners was formed in 2016 in Melbourne, Australia, and our goal is to be your global growth investor. So that is our goal. We started the business with just 20 million under management, and as of today, we have nearly $4 billion in assets under management. The fund, the flagship Munro Global Growth Fund, as Steve said, has done a 17.8% per annum return over that time frame, and over time we've provided that in other forms. It's now quoted on the Australian Stock Exchange, and also we've launched a long-only mandate on top of that. But the goal hasn't really changed from the very start, is to be your global growth investor. We're here to try and find those few exceptional companies around the world that do amazing things. They're companies you use every day, like either Netflix or Amazon, and our job is to go find them for you, and we effectively looking for you to outsource that to us. And the business has grown very strongly, really for three reasons. One, we had a strong track record previously. Two, we got distribution from Grant Samuel, which allowed us to get rated very strongly, and also got us into Canada. And the third reason why we've gone very strongly is really that last reason, is people have recognized that global growth investing is required in their portfolio, because we are going through a period of significant change. And we're going to spend a lot of time talking about that today. Just a very quick update again. Look, we are a partnership. We are all based here in Melbourne, Australia. These are the Munro Partners as we speak today. The beauty of the partnership is we effectively own and control 75% of our business today, with the last 25% controlled by Grant Samuel. And from that point of view, everybody is on some form of income or profit share. And so ultimately our fate is designed by the performance of our products. And so we are very much 100% aligned with our clients. The team has grown and continues to grow. So we have, as we have become more successful, we have continued to invest in our business. These are some of the new additions we've had throughout the year, both here and in North America. And you can continue to expect us to add to that as time goes on. That's the business. In terms of how we invest, just very quickly, I've shown this slide since day one. I'll show it one more time, and I apologize for the people who've seen it a few times, but it is important just to remind people that we are a growth investor. So earnings growth drives stock prices. So we simply believe if a company makes more money every year, we generally find its share price goes up. Sustained earnings growth is worth more than cyclical earnings growth, and the market always misprices growth and its sustainability. And so what's fascinating here is we're nearly 5 years old, and I've been showing the same two companies since the very first day. On the right is Bank of America, and on the left is MasterCard. And what we're just simply saying here is that the black line is the Bank of America share price, and the blue line is its 12-month forward rolling EPS. And all we're saying as global investors is we don't actually know where the earnings of Bank of America are going to go. It relies on the economy, it relies on interest rates, it relies on a whole bunch of things that are macro-related. We have a view, but our view is as good as anyone else's. On the left, you have the MasterCard share price, and the black line is the share price, the blue line is its EPS, and it's benefiting from the shift from physical to digital cash. And what's amazing is everybody knows this, everyone's known this for a very long time, but the market can't price it in. The market will often misprice growth and sustainability. And our job is really to find this MasterCard situation over and over again. That's what we're trying to do, that's how we do it. Last philosophy slide, I promise, in terms of introduction. The reason why we do this is because we just think it's all that really matters. And so I know you've probably been on a lot of webinars this year already. You've probably listened to strategists talked about being over or underweight sectors, or over or underweight the US, or over and underweight emerging markets when they look at equity markets. We just think that's a complete waste of time. The equity market is incredibly simple. It's made up of very, very few exceptional companies and thousands of really mediocre ones. And our job as your global growth investor is to find those few exceptional companies. That's basically what we spend all day doing. And this is just a simple slide. It basically shows you, it came out of a Besson-Binder study back in 2017. He said, what would happen if you bought and held every company that ever listed on the US stock market over the last 90 years? There's actually 26,500. And what you'd find is the top 50 out of those 26,500 now make up nearly 50% of the value of the market. And so that's 50 companies out of 26,000. So this is a game of few winners and lots of losers. If you plot those companies in annualized return in life and month, you'll see they're all benefiting from some form of structural change, whether it's digitalization with Amazon, Facebook, and Google, or software with Microsoft and Oracle, or big box retailing with Home Depot and Walmart, or quick service restaurants with McDonald's. It's always the same. There's a big structural change. There's a couple of winners. Our job is to occupy this top left-hand corner and identify the structural changes and find those winners. And so that's what we're doing here on the right. You're not going to find it with the quant screen. We're doing 500 meetings per annum. with basically companies and their competitors. We identified 20 structural areas of interest or themes. We're going to be talking a lot about these today. And we basically work within 1,000 stock universe to create a very concentrated portfolio of companies that we hope or we think will be the next exceptionals or the current exceptionals. And if we do that, that's what drives our returns. Last thing just to flag in terms of way of introduction second last thing to flag is we obviously, as Steve said, offer this in 2 products now. There's the Munro Global Growth Fund, which is our absolute return product. So we end up with a concentrated portfolio of 30 to 50 positions. There, we're trying to give you meaningful positive returns over the cycle. So we think double digit per annum. We've actually done that now for 15 years across 2 firms. It's not a straight line, I'm afraid. And there we have these levers where we can take cash to up to 100%. We can short sell, we can buy things like put options. We'll talk a bit about that today. This product runs at a lower volatility than the market, but currently has returns above the market. And this is the product we have quoted on the Australian Stock Exchange under MAET. And that's effectively a feeder fund that just basically makes it easier for lots of people on this call to get access to our 30 to 50 ideas. You simply just invest in MAET and that invests in the fund. And it should track the fund perfectly because it has a market maker. The second product we have launched is our long only product, which is the same thing, just but without the downside protection tools. So this is a fully invested, much more like a relative return fund. So this one you could compare to, say, a Platinum. This one you could compare to, say, a Magellan. Much more of a long only product. Will be much more volatile because we're not using the downside protection tools. Both of them are available, but effectively have the same ideas. And then last thing, just to flag on how we think about that. All we're saying here is both products do the stuff in white, which is what we do and every other fund manager in the world does, which is that we have an investment team that follows an investment process, does active research and picks stocks with high conviction. And I just told you the stocks we're looking for. We're looking for those exceptional companies. We do run stop losses in both products because often we're going to make mistakes, and I'm sure that'll come up a bit today. The difference between the absolute return and the long only product is the stuff in yellow. So the absolute return product has the ability to hold up to 100% cash, can buy a put option, can short sell, has a much more of a capital preservation mindset. And that's the difference between the 2 products today. And then lastly, just in terms of performance, obviously that's the proof in the pudding. This is the absolute return product since inception, which is all the way back in August 2016. And what we're really focused on here, as I said earlier, is that double digit returns per annum. We've managed to achieve 17.8. The goal is to keep it above 10. And what you can see is you're doing it with lower volatility. So this product's much more suitable for maybe older investors or investors who basically don't like losing money. They're not as concerned about relative returns. They just want to make money and not lose money. This is the product that's suitable for them. But on top of that, as I said, we have now launched the long only product. This is our relative return product. It just has the 1-year track record. But ultimately both are available. And anything I skipped over today, please go to our website and have a look. But that's my short introduction, Steve. So happy to roll into the questions now.
Okay, terrific. Thanks, Nick. And we're getting quite a few questions come through already, which is great. So please keep those questions coming. I'll start off with the first one, and we'll just get back to, I suppose, a couple of my comments in the opening, just around the outlook. What is your outlook for 2021? And I suppose, what are the key risks to this outlook?
Yeah, so from our point of view, in terms of when we think about the outlook for the market, we really do look at the equity market relative to interest rates. And so we have lived in this fairly strange world for a long time where interest rates keep going lower and lower and valuations keep going higher and higher. And I just don't think you can look at valuations in an absolute sense because it, quite frankly, just doesn't work. Every investor in the world has a choice as to where they put their money. The bank is currently not offering very much. And so from that point of view, we look at the world by an equity risk premium. And so the equity risk premium is if you take 1 and divide it by the PE of the market, you can do this for the Australian market or the US market. And assuming the PE of the US market's around 20 times, just for simplicity, that would mean the earnings yield of the market is 5%. It's actually a little higher than that at the moment. It's 22 times. So the earnings yield's around 4.5%. And then if you subtract the risk-free rate, the US 10-year bond, that's the earnings carry you're getting for owning equities today. You're getting a 3.5% roughly carry for owning equities today. And if we look at that versus history, it's not excessive. It doesn't make the market look expensive. In fact, it looks roughly the same as where we've been for a long time. The difference is back here, or back in the 2000s, interest rates were 6%, and now interest rates are 1%. And so if you think the market's overvalued, you need one of 3 things to happen. You need, for some reason, for this to go back to 6%, or for some reason for this arbitrage not to continue closing. And so from our point of view, when we look at the overall market, the way that this equation is wrong is either earnings are wrong, so we need earnings downgrades, And we think that's highly unlikely as we recover from COVID. And we've just had one of the best quarterly reporting seasons that I've seen in the last 4 years in terms of beats. The second reason why it could happen is because interest rates go up, or the 10-year interest rate go up. Now that could happen. I mean, obviously the RBA and the Fed don't want to raise rates, but the long end of the curve could steepen. That could happen. Or the last thing that could happen to close this gap is that equity markets go higher. And so from our point of view, we think the path of least resistance is markets go higher. And it's a very long way away from where we were in 2000s, where you're getting no carry at all. And this is for the overall market. I will talk about some of these sections of the market in a second. The other thing that's going on that a lot of people are missing is that the equity market's not really the economy. It's been this way for a long time. It's got worse post-COVID. So this is the top 10 in the S&P 500. They make up 31%. This is their last 5-year sales growth. Okay, the economy is not growing at 5-7% plus, but these companies are, and they're some of the biggest companies in the world. Why is that happening? Because they're disrupting. They're either disrupting or they're taking share, and so you have this huge weighting towards disruption, and all of these disruption companies actually accelerated through COVID. Also on the right-hand side, it's worth flagging that even the companies that are affected, like your Boeings or your Walt Disneys, because of what the Fed did in investment-grade credit. So, as you know, at the bottom of the market, the Fed bought investment-grade credit. The Fed bought high-yield credit. What that did is it allowed, this is the LQD, or the investment-grade credit ETF in the US. And what you can see is it's closed further. So if you're a high-grade corporate in the US or a rated corporate in the US, you can actually borrow money now cheaper than you could pre-COVID. And so what you have is this situation where a company like Starbucks can just take share. So small businesses suffering, big businesses winning. And so the inequality we saw before COVID is actually worse after it. That will have consequences, but that's just something to understand in terms of the maths of what I showed you before, which is that earnings growth versus interest rates. So in answer to your question, Steve, as to what could go wrong, look, lots of things. And it's important to flag that I did stand up and give a very similar presentation February a year ago, saying what could possibly go wrong. And I think it gets overblown by the press. Nothing's really going to go wrong. And in the end, we had a once in 100-year pandemic. So it's important to stress that no one really knows what's going to go wrong. And it's always the things you don't know that catch you, not the things you know. But the things that we would flag is COVID could come back, obviously. I'm not going to comment on the virus variants or whether the vaccine works, but I do think that the market can overall cope with COVID coming back. I don't particularly want it to come back. Don't think anyone on this call wants it to come back, but I think equities prove that they could get through that. There will be winners and losers. Second thing is China is still an issue in the world and behaving a bit erratically. You see it in the Australian market. We also see it offshore. That would be a concern. The bottom two are probably our big ones. Obviously, inflation. Inflation, if all of this stimulus does equal inflation, that will cause interest rates to rise and all asset prices will fall. All of them will fall. Growth equities will probably fall more. And so this is something we're watching very closely. It is a valuation adjustment that will come if inflation gets out of control. But if interest rates rise slowly, then it's really nothing to worry about. And so from that point of view, that's probably the big one we watch most closely and try to hedge against. And then lastly, just to flag inequality. It's a big issue. It's going to get bigger. There will be tax increases, etc., down the track. The only thing we'd say about these concerns is on the opposite side, we do see offsetting factors. There is a vaccine coming. We do have a White House that's much more stable. Everyone says inflation is going to come back, but it hasn't come back for 10 years. So why is it going to come back this year? And it's important to flag that corporates are being much more responsible. And so they're actually not waiting to be told anymore. They're doing it themselves. And so that's how we see the risk at the moment, Steve. And then just lastly, I probably should address it because I'm sure there's 15 questions I haven't checked yet, but I'm sure there's lots of questions about either GameStop or some of the speculation we're seeing in the market. I think it's understandable that you see speculation at this point in time. What we're seeing is retail investors coming back to the market because they can A, open accounts really easily, and B, they're not getting a return from cash. It's important to stress that a lot of that speculation is really in just small stocks. Like GameStop's a tiny stock. Some of these EVs and SPACs are tiny. And so, yes, it is a warning sign, but in the same breath, you may think Snowflake's invested at 100 times sales or Zoom's expensive at 60 times sales, but it just doesn't mean Microsoft's expensive at 28 times earnings, growing at 15% with a 2% dividend yield. It's just the overall market is not actually expensive. And so these little bubbles that are forming around us, they're popping, which is good because retail investors are learning. And ultimately, we don't think it's enough to derail the whole market at this time because they are just happening in the small stocks, not in the big ones. And if anything, what we hope is this is a VIX volatility slide. and this is a VIX volatility slide over the last 20 years. And having been through the financial crisis myself and through the dot-com boom, generally when you have one of these big volatility events, you actually have a period of calm. And I sincerely hope that we have a period of calm after this one. And so while the mass backs it up, hopefully the government policy backs it up, and hopefully the market does as well. So we are still positive equity, Steve. We've been positive throughout the back end of last year. We're positive at the start of this year, and we still get the mass to add up today.
Okay, so Nick, just based on your outlook then, so how have you got the portfolio position for the year ahead? And I suppose what changes have you made to the portfolio to position for the economic recovery that you potentially spoke about? One area that our advisors always like hearing about is the evolution of your areas of interest. So more specifically, can you speak to how have your areas of interest in terms of representation in your portfolio shifted before 2020, during 2020, and how are they positioned today?
Yeah. So thank you, Steve. So this is a slide of our areas of interest in the fund. And so I'd encourage anyone to look at this. It's in our monthly report, it's in our quarterly reports, and it ultimately summarizes how we think about the world. And so as I said at the start, we're trying to find these areas of structural growth, and we're trying to find these structural winners. These are the weights as they were at the end of January. And so at the moment, climate makes up 17% of the fund, with 8 positions, of which Orsted's one of the biggest. Digital enterprises, cloud computing makes up 15% of the fund, e-commerce makes up 10, semiconductors make up 10, healthcare make up 10. And so in every case here, we're trying to find an idiosyncratic area of growth, find the earnings growth. Earnings growth will equal the share price growth. It's as simple as that. So what happened in 2020 was ultimately when we hit COVID, we pivoted very strongly towards the digital winners. We did. Digital and healthcare winners is really what drove that 40% return last year. So as we came out of COVID, and so that was really e-commerce, cloud computing, innovative health. The things that we've changed as we head into 2021 is that so most people are obviously saying you've got to tilt cyclically. We might talk about that in a second. But the thing that we have changed is we've moved climate up to the #1 position. Climate we see as a strong beneficiary of stimulus. We see it as a strong beneficiary of Biden winning the US presidency. All of this was going to happen previously. We now think it happens much faster. And so from that point of view, that's been a very strong performer for us in the last quarter or so. The other area that we moved up a lot is this area called high performance computing. So we've always liked semiconductors for structural reasons because of connectivity in the cloud, but they also have a nice cyclical bent. And so it's that cyclical bent that you now see playing out today where we're hearing about semiconductor shortages, et cetera. So that's companies like ASML and TSMC, and again, been very strong performers. And so what that basically meant that even though the vaccine was announced in the fourth quarter, and you saw this big rotation, the funds actually still outperformed in the fourth quarter and have continued to outperform this year.
Okay, so just looking through your areas of interest, digital companies still appear to make up a large part of the portfolio. So how do you see them performing once COVID has passed? And is there a risk they'll underperform from here?
Yeah, so lots of people on the call are probably sitting here going, surely the narrative is the vaccine comes along and, the economy is going to open up and you need to own cyclical and you need to own inflation and you need to own reflation. And look, I completely see that point of view. I completely get it. And I think on a 12 to 18 month view, it could probably work. But remember, it is a trade. At the end of that period, you're still going to end up owning this, quite boring bank, or you're going to end up owning this quite boring oil company. And so from our point of view, when we actually look at these digital areas, we actually see them as looking more exciting than they've ever looked. And so we're just really reluctant to do that. We are your global growth investor. And if we think on a 3 to 5 year view, the opportunities are better than they've ever been. And maybe I'll just take you through a few pictures to show that. The simple way of thinking about this is a couple of things we'll show you is we always talk about these S curves, right? So when you think about the smartphone adoption, people have seen me do this slide 1,000 times. The global mobile phone market went from feature phones to smartphones. Smartphones went from a 10% share to an 80% share. Apple went from $50 billion to $2 trillion. That's what happened. And from our point of view, we invested in Apple in 2010. We made 7 times our money. And the geniuses that we are, we sold it all in 2016 because we basically thought they wouldn't sell any more iPhones. And we were right, they didn't. But they pivoted into all these recurring revenue businesses like the cloud, like the app store, like payments, like wearables, etc. And so from that point of view, we've left a whole bunch of money on the table. When we roll this forward into what we've been following for a long time, when we think about these S curves of adoption that we follow, because this is what we look for when we look for structural growth, Steve, is that when we look at e-commerce, we see e-commerce has followed this very stable path for a very long period of time. You know, we bought Amazon in 2013 based on this, that e-commerce share would go from say 10% to 40%, and it would take 30 years. But what happened in COVID is it accelerated really quickly. We got 5% of share growth in just 1 year. Exactly the same thing happened with cloud computing. Exactly the same thing happened with internet advertising, and exactly the same thing happened with digital payments. So all of our disruption curves actually accelerated. And on top of that, we see a lot of these companies now trying to bust out of their TAM. So you see Amazon moving into healthcare, Facebook moving into e-commerce, and PayPal moving into digital currency, etc. And so from our point of view, we actually think the habits that you formed in COVID are going to stick. It's not just going to be this one-time thing that goes back again. And if you actually plug that through our models, we end up with much more upside. It's also important to understand there's another important thing happening, which is the supply side of tech. So while the demand side of technology adoption has accelerated, i.e. the habits are going to stick, the supply side's also accelerating. And so again, I've shown this slide before, but you know that computers are getting faster, okay? You know that Moore's law will allow computer power to grow exponentially. And so what that means is as computers get faster, up to 54 billion transistors on the latest chipset, if you think about the internet, it disrupts faster. So it used to just do search, then it gets on your phone, then it does shares pictures, then it does e-commerce, then it does digital payments, then it does streaming Netflix, and now we're up to sort of video games, software, and all these peer-to-peer businesses. And so the thing that happened during COVID that I suppose we're most excited about is that what would normally take a long time for technology to be picked up happened very quickly. So the demand side accelerated at the same time as the supply side accelerated. And the best example of this is Zoom. So everyone just suddenly had to work out how to use Zoom. And Zoom creates like $100 billion in market cap out of thin air. And we think that will continue. And so from that point of view, when we're looking at these areas of interest, what we're actually saying, and this is an analogy, and you're probably wondering why you've got Australian Open tennis players on your thing, but the analogy we're trying to flag here is really when you look at the tennis players. And so right now we're here in Melbourne, Australia. The tennis is on just a short while away. There's no one going, by the way. It's very sad. But when we think about technology now, and when we think about the next few years, how are we going to take account of this acceleration? And the best way to think about it is in technology. For a long time, we've had the big four. The big four on the left here being Federer, Murray, Nadal, Djokovic, and I'm getting a lot of flack for having Murray on this slide, and I'm sorry, but he's a Scot. He deserves to be there. But the reality is I needed four because these are the big four in technology, being Apple, Facebook, Amazon, and Google. They've been around a long time, and they're going to still be around a long time. They're still good. But what we need to start thinking about is who are the next generation coming through? Who are the next companies that are disrupting large addressable marketplace? Because we know that it's going to happen. And this is just a good example of some of the ones that are in the fund today that we quite like. And the best way to think about this is if you think about a company like Twilio, you know, digital marketing leader. Every company in the world right now is trying to think about how do they solve digital marketing. They're going to pour into Twilio. If you think about ServiceNow and Atlassian, every company in the world is thinking about doing their work from home. Money's going to pour into work from home, into how they do their software as a service. And lastly, if you think about HelloFresh, you know, all of us discovered, you know, eating food at home and getting your groceries delivered, you know, think about how big HelloFresh's market size could be. And so from that point of view, this dual acceleration is allowing these opportunities to appear much faster. And so from our point of view, we still think it's a really exciting place to be, Steve.
Great. I just noticed a message come through there, Nick. Where's Sitsipas?
I get a lot of grief for this slide. In hindsight, I probably shouldn't have built it, Steve, but that's the analogy we're trying to take.
Very good. Let's just move along. So an area of interest I know that Munro is strongly focusing on in 2021 is climate. Can you tell me more about this area of interest and where the fund is positioned?
Yeah, okay, thanks, Steve. So these are areas of interest. So remember, as I said at the start, we are your global growth investor. And so these are the areas we want to focus on because we're trying to find structural change and we're trying to find those winners. And so from that point of view, these are the areas where we think is a good place to look for them. And this is some of the work we've done. And happy to go through any of these in the Q&A if that helps when we have time at the end. But when we look at the climate one, it is probably the most exciting one. It's the biggest area in the fund today. And really because you're effectively right at the start of that S-curve. And so if you think about the internet, you know, we just spent a lot of time talking about digitalization and how it's still going to keep happening. You know, the internet's nearly 20 years old. In fact, it's more than 20 years old. And so you've had this huge adoption that's happened over a 20-year time horizon and is still creating great companies today. Climate's actually right at the start. And so what we saw in 2019 when we first started looking at this, and again in 2020, is, you know, this sort of epidemic of people launching zero carbon targets, whether it was EU wanted to go to zero carbon by 2050, or whether it was Microsoft, Google, and Amazon all announcing, or whether it was TSMC, or whether it was the Melbourne City Council. Every single person seems to want to be zero carbon by 2050. If you look at the Europeans, they've got the best plan today where they've actually accounted for it. And the Europeans have basically said they think it's going to cost $10 trillion to do it over 30 years. And these are the areas you're going to be. And what we've done is we've grossed it up to 30 trillion for the whole world. But if anything, I think that's a bit low. And the important thing to understand here is if you want to go to zero carbon, you're not saying you're going to emit less carbon. You're saying you're going to emit no carbon by 2050. And so this is just going to be really, really expensive. And so our job as your global growth investor is to follow the money to these areas and find these winners. And obviously, a lot of airtime around passenger EVs because of Tesla, but it's not the only place the money's going to go. It's going to go to energy efficiency, renewable energy, heating at trucks, transmission grids, etc. There are lots of different plays here, and our job is to do the work and go find them. And the reason why we like this so much is because if you just think about where we are on the S-curve as to how long this could go for versus the ones I showed you earlier. And so this is our global onshore wind. This is how much of the installed capacity is in the world today. This is what it has to get to zero carbon over time frame by 2050. This is global offshore wind. This is how much installed capacity there is today. This is how much it has to get to. So they're auctioning as much global offshore wind capacity this year as there has been built in the entire time frame of offshore wind. And so from that point of view, you are really right at the start, and these are some of the companies that could win from it. Think about batteries. This is where battery production is today. This is where battery market size is today. Ultimately, you're not talking the market size doubling. You're talking more than 10 times the size over a period of time. And so there's huge S-curve of demand laying out in front of it. And all the market's doing is saying, well, we can see this now. And so what we should start doing is pricing into the share price. They're pulling it forward because it's so clear that it's going to happen. And the last and most obvious one that we've seen is electric cars. 3% of all cars today sold are electric. Tesla is 26% of those cars. What's going to happen when 80% of the cars are electric? Is Tesla still going to be 26? Is it going to be 20, or is it going to be 15? Or is it going to be 10? That's the sort of model you have to build to try and work out what Tesla's worth. And there's no point looking at next year's earnings multiple. It's a waste of time. You should look much further out because you know this is actually going to happen. And that's what the market's doing here. And so from our point of view, some of the companies we like that are in this area, things like Ørsted in Denmark, offshore wind generation, definitely benefiting from that long curve, owns a lot of the lease or has a lot of the lease facilities already. When TSMC wants to build an offshore wind farm, they talk to Ørsted. And so from that point of view, we get it. This is a 100 billion market cap today. No reason why this can't be a super major at some point in the future. It's no different to BP running around Iran in 1970. It's the same sort of concept. And it will take time, but it should happen. Elsewhere, Samsung SDI, South Korea, one of the about 5 battery manufacturers in the world. This one has a market cap around 40 billion. It obviously does electric vehicle batteries and scooter batteries and phone batteries. But the thing we like the most are these container batteries, because every renewable facility in the world is going to need a battery next to it. If renewables need to be baseload, which they have to be in a zero carbon world, then you have to have a battery with them. And so from that point of view, because it's not sunny all the time, the wind's not all the time. Again, 45 billion market cap. Yes, it's a high multiple, but next year is not relevant. What's relevant is what's going to happen in the long term. And we built the models to suggest there's upside. Smaller one, Alphen in Holland, 2 billion market cap. These guys are really focusing on the grid and how to make sure the grid is powerful enough to cope with all these different types of energy coming in. And they also build charging stations. Very small company, but a very long runway in front of it. And then lastly, I might as well go there because I'm sure it's in the 26 questions that we've already got, Steve, that you need to work your way through, is Tesla. So this is actually a slide that I showed a year ago. And it really was just about framing the upside. How big could Tesla be? And I'll just bring it back to how you should think about climate versus how we thought about smartphones. And so go back all the way to 2008, 2009, when we were doing the work on Apple. This is the size of the global mobile phone market, roughly $500 billion per annum. And Apple was a $50 billion company down here. And we hypothesized that, Apple would get, 50% of the smartphone market, i.e. 20% share, but their phones are twice the price. And so eventually it could end up, 250, 300 billion to market cap company. That's what we thought. But what happened is they ended up getting 80% of the phone market, and then they built all this app business and all this other stuff on top of it, and ended up being a $2 trillion company. That's what actually happened. A year ago when I had this slide, I was flagging that, the car market's $2.5 trillion. So Tesla's trying to disrupt the car market in the same way that Apple tried to disrupt the phone market. And both companies, by the way, have very vigilant consumers who seem to love their products. And Tesla had a 50 billion market cap at that point in time. And so all the market's doing is looking at this market and trying to work out how much they're actually going to get and how much you should discount that forward. And so while I agree Tesla's gone up a lot, it's probably got a bit ahead of itself at the moment. The opportunity is still there. And so from our point of view, we think it's an important part of the fund, albeit small. And ultimately, I think we'll still be talking about this company 5-10 years from now. This is definitely not a bubble.
Okay, Nick. Well, let's move on to the last question before we go to the Q&A with our audience. And it's around risk management. And in my introduction, I spoke about how effective, the risk management was last year, right on the peak of COVID, or the equity market drawdown as a result of COVID in March. You were able to deliver a positive return in March when global equity indices fell quite a lot in March. So what risk management tools do you currently have in place today, and how have they protected the portfolio historically? How have you implemented those tools? And when do you put these risk management tools, i.e. options or shorts, whatever it may be, in place?
Yeah, thanks, Steve. Okay, so managing risk. So this is just the most important part of our process, and so I'm glad you left it to the end, Steve. Look, from our point of view, everything we just said is our view. Okay, it's our view of the world based on probabilities of what we know now. And I think we've all learned in the last 12 months is the world changes, right? Things change, okay? And so what you have to think about as a fund manager is, what are you going to do when things change? What are your risk management tools? You can't just make it up on the go. You need actually some rules in place that you have to follow. And that's what really helped us here, Steve. So I'll talk about risk management at the stock level first, and then I'll talk about the alternative funds. So at the stock level, our goal here is to build funds of 30 to 50 positions in the long short fund, or 20 to 40 in the long only fund. And remember, as I said at the start, we know there's only going to be a few winners, there's going to be lots of losers. So by definition, we're going to invest in losers. It's going to happen. What we do there is we try to manage these areas of interest to keep them all different and idiosyncratic. We also have maximum position sizes. We set price targets, which we review. We also have liquidity rules that we follow. 80% of the fund, and the absolute return fund at least, has to be able to be sold within 10 days. But the last and most important thing we do, and I encourage people to take it away, and it's something we learned at our previous firm, is stop losses. They work incredibly well. Any stock that falls 20% from peak or from cost, subject to a review. Doesn't mean you have to sell it, but you've got to review it. You've got to review the investment case. If you all decide to keep it unanimously, you can keep it, but you can only keep it for 30 days. And then if it's still triggering, fall from peak or cost, you have to review it again. You have to review it again. And what eventually happens is you realize that BlackBerry's not going to be the smartphone winner, or eBay's not the e-commerce winner. And so from that point of view, it creates these things. These are our top 10 winners since inception in the fund in basis points contribution to the fund. These are our top 10 losers. So we've never actually lost more than 100 basis points on any one stock for the fund in 15 years of running money. Yet we have multiple stocks that have made more than 500 basis points. So that's the simple maths behind making sure you find those exceptional winners and running them, and be very vigilant about cutting your losers. And we do that across both funds. And so when you go back to last year, lots of stocks obviously triggered during COVID, but it was reasonably easy to work out which ones we should keep and which ones we couldn't. Should we keep Amazon or should we keep Airbus? I mean, that wasn't a hard decision. They both fell 15 to 20%. We moved the Airbus on quickly. We kept the Amazon. And so that's what the triggers enable you to think about. On top of that, the absolute return fund has this variable beta mandate. So it has the ability to buy put options, or to short sell, or to hold more cash. And this is just a good graphic of what the absolute return fund's done since inception. We are running at roughly 70 or 80% long. We do have the ability to drop the exposure very low to 20% in many cases. We're not selling the whole portfolio when we do this. We are either short selling futures or buying things like put options that explode in value and create synthetic shorts. And so these are what we call our capital protection tools. And to give you an idea of how they've worked, Steve, this shows you the December quarter of 2018. which was one big drawdown that we've dealt with. And this is the March quarter of 2020, which is obviously the COVID drawdown. And so in both cases, our long equities fall. We're not immune to equity markets falling. It happens. I think we've all dealt with it. Back here, the market fell, I think, roughly 14%. We actually fell more than the market through this period. Our long equities did. But our short equities offset that, as did our put options that we had in place, as did our US dollar exposure. And so from that point of view, that ended up being a 10% drawdown. Our long only fund actually did closer to a 20% drawdown through that period. And so we managed to lower the volatility there. When we look at the COVID quarter, our long equities again went down, but only 12%, mainly because we happened to be in some of the right areas. And we also were very quick to stop loss out those companies that were in the wrong areas. And our short equities were very good, very profitable through that period, as was our put options. And COVID was a classic period where a put option helps, because it was a massive left tail event. I'm more than happy to put my hand up and say I was a guy who didn't think COVID would be a big deal. And these put options that we just had them in place before COVID hit, because we were just worried that, we wanted to be fully invested, but we should put a safety net in place for this COVID issue that everyone seems so worried about. And in the end, we turned that into a 7% return. And so from that point of view, as you go forward, Steve, what we're saying in terms of the capital protection tools we have at the moment, they're not very many. We are quite bullish markets at the moment. The fund is over 90% exposed. It's important to stress that we do have some put options on in the market at the moment, but what's more important is how quickly you use these tools and how liquid you are in your ability to use them. And so we didn't see COVID coming, and that's what we'd managed to generate. And I think what you should get some comfort on is that that's what we're trying to do in the future. We will move quickly on these things, particularly with the absolute return fund, because it is a downside protected product. We have the relative return fund that stays fully invested the whole time. Last thing I'd just flag on this is it's important to stress, back to the areas of interest, we are trying to construct these portfolios, with not a whole bunch of high multiple stocks. In each of these areas, digital enterprise, we include Microsoft, and we also include Atlassian. So one's quite expensive, but we're quite excited about it. One's Microsoft, has been around a long time. We think it's fine. And so we are trying to make these areas of interest not correlated to each other. And also within these areas of interest, we have a mixture of emerging stocks and also established stocks. And so that also, ultimately at the end of the day, it's the stocks you pick that will define your ability to manage volatility. And that we're very, very serious about.
Excellent. Okay, Nick, thank you. Well, we've got plenty of questions coming through. So I might start with this one. There's been a lot of talk around value investors versus growth investors, and how value investors may now perform better after the incredible run some growth investors have had. The question is, why are the two mutually exclusive?
Yeah, good question. I think I'd go back to what I said earlier. So I'll just go back to here just really quickly. To this slide here and the slide I saw earlier. I mean, value investing effectively relies on mean reversion. And yes, they could do with a cycle as well. So there's two things that are slightly working against value investing at the moment. One is they could do with a cycle, and I completely see that. So they want the bottom of the market to the top to work. And they need interest rates to be in a cycle. And I think that makes perfect sense. And if you think interest rates are going to go up from here and inflation's going to come back, I can completely see an argument as to why value would outperform growth for a period of time. But all it does is a valuation adjustment. It doesn't actually change what's going to happen in the long run. What's going to happen in the long run is what we know is that I'll just go back even further, is that there's only going to be a few winners. I mean, this is the reality. This is the reality of what's going to happen over a long period of time. Over a short period of time, I can completely see if interest rates go up, value could outperform. But over a long period of time, this is what's actually going to happen. And so then coming back to what I showed earlier, when I look at these value companies, the problem with a lot of them is they're scrambling to catch up. So this concept that mean is going to revert, and that an old car company is going to catch up to a new car company, that's actually not what's happening on the ground. What's happening on the ground is Moore's law is accelerating, disruption is accelerating, and I see a lot of companies continuing to eat into other companies' business proposition at a faster and faster rate. And so then what you end up with is these value traps. And so from our point of view, our goal is to find where you're a global growth investor. That's where we fit in your portfolio. Our job is to find the next exceptional companies. And what we're saying is we can keep finding them quite easily at the moment. The last thing I'd just say on this value argument, just really quickly, which is a slide I didn't get to do earlier, is a lot of people struggle with this next year's multiple thing. So they struggle by looking at the company and they go, geez, this company's so expensive. How can you possibly buy it? It's a disaster waiting to happen. And I completely get why people see that. And sort of our job is to do the work to get through that. And so this is just the reality is from our point of view, is short-term multiples aren't going to help you find a long-term winner, okay? So for the last 10 years, everyone's told you Netflix is a bad investment, yet all you did was go home and watch Netflix. And so all you had to do was work out that there's probably only going to be 4 or 5 streaming services, and Netflix is probably going to be one of them. And what you should be doing is not looking at next year's multiple, but looking at how many subscribers it will have in 2030. That's what you're actually paying us to do. That's what you're paying us to work out. And this just hasn't been happening for a little while. It's been happening for a long time. And so this is a study we did. If you go back to the peak of the market in 2007 to the peak in 2020, so not the bottom of the market to the top. That's again when the value guys would come into play. The top to the top, we're the growth guys. We just wanted funds that win no matter what. And if you look at that period, there was 66 companies that went up 10 times in value, or the 10 baggers. And if you look at the 10 baggers versus the market, 80% of them had revenue growth of over 10%. Yet the market, the non-10 baggers, 80% of them had revenue growth below 10%. And if you look at what you had to pay for them, more than 50% of them were over 50 times earnings. And the other half were less, but most of the market, more than 50% of the market was less than 20 times earnings. And so the mediocre companies are priced like mediocre companies. The exceptional companies are priced like exceptional companies. And our job is to find your way through this and find the ones that are going to win. But what I can tell you right from the start is the short-term multiples won't help you find them.
Okay, Nick, we should just touch on GameStop a bit further, just regarding that fiasco. How does this affect your shorting positions moving forward?
Okay, so from the short side of things, look, it is obviously slightly problematic that you can't short a company like GameStop, because something like that will happen. We always are avoiding fairly crowded shorts. We would always look at that. In GameStop's case, it was more than 100% of the free float short. The other thing to flag is shorts only make up sort of between 0 and 15% of the fund today. And at the moment, we're only running the one individual stock short today. And so from that point of view, we think we need to be a little bit more careful about individual stock shorts. It doesn't mean that we wouldn't short futures, for instance, to hedge the fund. But these are all things we were doing pre-GameStop. But I think the only thing that's really changed is, there's now another variable that comes into play when you short sell. The last thing I'd just say on short selling is we're very vigilant on our stops on short selling. So if they move more than 10% against us at cost, we need to cut them. And we do that fairly consistently. And so the reason why we only have one short left in the fund today is because most of them got triggered back in December. And so we've sort of just stepped away for a little while. It will come back. It is about timing. And just to flag again back here, sorry to jump around, just to flag back here, you can see our short positioning going up during COVID, and then obviously us closing our shorts here. And so that's something that it is very much a timing-based tool for us.
Okay, just regarding regulatory risk around big tech, both in developed world and China, what are your thoughts around that?
So in the developed world, reasonably relaxed. It's been around for a long time. The one company we would flag that we've probably moved to the sidelines on the basis of regulation is Facebook. We just think Facebook's probably in the gun for the next 12 months. I think its earnings are going to grow dramatically in the next 3 to 5 years. I just don't know where the multiple's going to go. And the company may derate, because ultimately, if there's one thing everybody in the world agrees with, is that it agrees there's a problem with social media. I don't think there's a problem with Amazon. They're hiring 175,000 people a quarter. They're a force for good in the world. Google, is probably fine here. And it's important to stress that in the US companies in particular, there's a lot priced in already for this. And so even stepping away from Facebook's probably going to be like Apple and end up being quite good for us. But we have stepped away. And it will play out over a very long time because there's checks and balances in the US system. China, on the other hand, is a bit different. China, one-party state. We did own a large position in Alibaba. We have halved it on the back of what's happened with the investigation into Alibaba. As much as we don't think they will do anything in the long run dramatically to alter Alibaba's business model, we do think from a risk management perspective it remains safe to basically to reduce that exposure somewhat, mainly because we just don't, the Chinese regulators are different. You can't appeal to the Supreme Court and try and stop some law going through Congress, etc., which I fully expect Facebook to do in the US. And so that's really our view on regulation today.
Okay, so we've got to also just touch on Tesla. We've got a couple of questions here. So first, there's two questions. First one, do you still own it? The second question, with Tesla taking a large stake in Bitcoin, are there any opportunities in crypto going forward?
So the answer on Tesla is yes. Not as big as it used to be, but yes, still own it, and I think that's the right place to be. Why don't I talk about digital payments quickly? Because we do. Sorry, I've just gone. Yeah, bear with me. So as I said earlier, these are our areas of interest that we focus on. When we think about digital payments, we think this is actually really exciting, and so we are, open to Bitcoin. And we think of very interesting things about to happen in the digital world. So effectively, you're about to go to 100% digital currencies. Okay, so payments are going to disappear altogether. Oh, sorry, cash is going to disappear altogether. And once you go 100% digital, a really interesting thing is going to happen to the fintechs, which is that the traditional fintechs would have focused on e-commerce or digital consumer finance or P2P remittances or digital services. Yet most of the payment world is in-store, cross-border, or domestic payments, paying your babysitter, paying your gardener, etc. And so this is the whole world that they can now move into. And so a digital currency will obviously have a role to play here. And so the other way to think about this is this is the revenues of all the major banks in the world, and these are the revenues of all the major fintechs. And so we would argue that once cash disappears, and once you no longer need to go to a bank branch, why do you need to bank at a bank? The fintechs, the digital wallets will effectively exist for you, whether it's a PayPal wallet or an Afterpay wallet or a Square wallet. You will effectively, and these fintechs will be able to chip away at this revenue stream that the banks have over a very, very long period of time. Digital currencies come into this play because inevitably, once you don't go to a bank and you don't need cash and you're using a digital wallet, then why do you need exchange rates? Ultimately, eventually, you're going to need a digital currency, or I see a world where a digital currency could work. The problem you have at the moment is just not useful, so the wallets don't work. The wallets aren't very helpful. But if they solve that problem, then clearly there's a role for a digital currency. Whether that's Bitcoin or one of the other ones, I'm not sure, but there is a role to play. And these are the companies, and many of these companies like PayPal and others are going to be the guys that benefit from that. And that's what we look at when we look at digital payments.
Okay, just a couple of questions around the fund itself. So a couple of questions on this one in particular around capacity. How will growth in fund affect your ability to be active, move in and out of positions, which perhaps is your strength?
Yeah, so from our point of view, I'll come back to what I showed you earlier, and apologies for jumping around. So we have a rule in the absolute return fund. So in the long-only fund, it's invested all the time, so capacity is not an issue. In the absolute return fund, 80% of the fund has to be able to be sold within 10 days at 30% of average daily volume. So you can't be absolute return and not actually be capable of moving. So something can't change in the world and you can't do anything about it. So 80% of the fund has to be able to be sold within 10 days at 30% of average daily volume. As we have grown, that number stayed very consistently below 20%. So 20% of the fund is allowed to be illiquid. We've never really got over 10%. And at the moment, it's less than 5% of the fund is actually not able to be sold within 10 days. Otherwise, every investment we have is incredibly liquid. The other thing I'd flag is these retail investors coming to the marketplace are improving liquidity. So liquidity is actually better than what it was a few years ago. And so we think the capacity of the fund, we used to think it was up to $5 billion. We think it's probably close to 5 to 10 now in the absolute return fund, because our liquidity stats have been fine for nearly 4 years now. And so from that point of view, we haven't really had any trouble to date, but we do monitor it very closely.
Okay, and just a question, Nick, around Munro's areas of interest. So is the mindset behind areas of interest because hot sectors attract inflows, or is it potential for more multiple expansion? You just want to talk about what you define as your areas of interest.
I'd keep it much more simple than that. It's just so I'll just show you. So when we think about our areas of interest, what we're saying is there's a whole bunch of companies in the world that grow. So there's in the world, there's more than 24,000 listed companies. There's a whole bunch that profess to grow. And then there's the ones that are growing structurally. And so what we're saying about the ones that are growing structurally, and here's 6 of them, but we actually have 20. What we're saying, this is a good place to look for companies whose earnings can grow consistently over a long period of time, which will ultimately mean their share price grows consistently over a long period of time. Now, what I think the question's asking is, do they get overvalued over time, or do they price in too much growth? And that's where we're effectively building our models. So we're building detailed models on every company we invest in, and we're building detailed models on every area we look at. And what we're ultimately saying when we look at these things, sorry, just to scroll back a bit, is how much more do these S-curves have to go? So how much more can this go? How much more can the runway go? Because at some point they'll end up growing just at GDP. And that's what we're building when we build these models, and that's what we're pricing into these stocks. And so while it may look like you're just running around buying hot sectors, you're not. They're hot sectors because they've got structural growth. People are looking there, and because they're the obvious place to look for these few exceptional winners. And I think most people would agree we're looking in the obvious places. The harder bit is valuing the stocks, and that's what we do for you.
Okay. Now I'm just conscious, Nick, that we're coming up to 1 o'clock. So what I might do, I might just ask you one final question, and then after that we can then go back to the questions, because there's still a lot of questions coming through. And for those that can hang around and continue to listen to the Q&A, fantastic. For those of you that need to leave, then that's fine also. So Nick, I suppose just in wrapping up the Q&A session today, for the advisors on the line, what would be the one takeaway from the discussion today that links back to what you're doing at Munro Partners and what you're doing within your business?
Yeah, so from my point of view, and thanks, Steve, I mean, look, we'd encourage you just, if we didn't cover some stuff today, to look at the website. There are a number of videos on there where we detail what we do. But our goal is to be your global growth investor. It's what I said at the start. It's what this is up for. We recognize that you're constructing portfolios for your clients, or you're constructing portfolios for yourself. You're buying a bond fund, you're buying an Australian equity fund. Within global equities, we want to be your global growth investor. You can do that with our absolute return product, which is more capital protected, or you can do it with our long only product. Both of them are effectively trying to do the same thing, which is identify areas of structural change and the resulting winning and losing stocks. And our point of view is, if we can continue to find those winners, then we can continue to generate the returns that we've done for a long period of time. And we're very much aligned with finding those winners. So that's what we hope to do for you.
Okay, very good. Well, just a couple of closing comments from me just in wrapping up the session before we go back to the Q&A. And that's just to thank everyone for their ongoing support. It's been terrific. Thank you for joining the call today. And we will get to the capital cities as soon as we can, that's for sure. Just in terms of the offerings, as I mentioned at the start, we have 3 different offerings. We've got the flagship unlisted Munro Global Growth Absolute Return Fund, the long short fund. We now have an ASX quoted Munro Global Growth Fund for those investors that would prefer to access Munro via the ASX. And the concentrated product we have also. Now, in terms of the concentrated product, we are still getting it on platforms. It is available on a couple of platforms. If you do have some interest in the concentrated product, we'd love to hear from you, obviously, and we'll get in touch with you also just around gaining pledges and those types of things to get it added to platforms as soon as we can. But once again, on behalf of the team, thanks very much for joining us today. And Nick, I've got some more questions for you if you've got the time. So, Nick,
we're happy to go on, Steve. And yeah, the questions as I looked, they're getting increasingly left field. So let's go.
Yeah. Okay. So this one's just around currency. So the fact that you're 67% hedged is a reflection that you expect, possibly QE2 and possibly QE3 may not work. Given that you're usually 50% hedged, what are your thoughts around that?
Okay, yeah, good question. So remember, the absolute return fund is trying to get you double-digit returns after all fees and expenses on a 3 to 5 year view. The currency is something that we generally keep 50% hedged because we don't really know where the currency is going to go. And so from that point of view, why are we not fully hedged? We're not fully hedged because the US dollar is very helpful in terms of a downside protection tool, i.e. it usually goes up when the market goes down. Why have we hedged a little bit more at the moment? Really just because of this economic recovery that's clearly happening. And if interest rates went higher, then the Aussie dollar is very much correlated with the economic recovery. And so we don't like giving money back on our US investments from a rising dollar. So we've hedged a little bit more, closer to 60%, but that's sort of what you could expect from us in terms of just trying to hang on to our returns. We'll take that back to 50% at some point, and we may even completely unhedge at some point down the track.
Okay, Nick, just wondering whether there are any old world companies in the portfolio, or are they of little interest to you?
Yep. There's lots of old world companies in the portfolio. So the big one that's come back for us is Airbus. We love Airbus. We love air travel. We think air travel is a structural growth industry. It's not today because of COVID, obviously. So we owned it before COVID. COVID came along, we stepped to the sidelines. The stock fell 60%. We're comfortable buying it back down here because we believe the vaccine will work over a 2 to 3 period. And if you look far enough out, we're going to fly again. And when we fly again, there's only 2 companies in the world that can build an aeroplane. And one of them's in a bit of trouble at the moment, Boeing. So Airbus is structurally very advantaged here. So that would be one. Another company we quite like a lot is Ryanair in the UK. Again, so while business travel mightn't come back, holiday travel will definitely come back. I know I'm going on holiday, and I hope everyone on the call is as well. And so Ryanair is an obvious beneficiary here, and obviously a lot of their competitors have gone a bit broke. Those would be the 2 ones I'd flag at the moment. Other areas we've liked in the past that we could come back to are luxury goods, and even within our climate change area of interest, we own utilities, and people wouldn't think of utilities as structural growth stocks, but in Europe they are. And so from that point of view, we own some utilities like NextGen and NL, and so they're very low beta, low risk companies that we think will structurally grow over a long period of time. So we quite like them.
Okay. Just looking at risk management again, your put options, are they specific stocks or indices? You want to talk a bit about your...
Yep. So the put options, generally, they're very short dated on indices, usually. So things like NASDAQ, S&P 500, Hong Kong Exchange. And so generally short dated around events. So there's no guarantee that the put options will be on at all times, but they're useful for things like US elections or when the markets get overextended, or COVID. And so from that point of view, you try to buy them when volatility is low and when they're cheap. And they're just a safety net. So we recognize we're taking risk with clients' money. We don't know what's going to happen, and so we like to buy these things as a bit of a safety net underneath. We don't know the big macro stuff, are the things that catch you out, and so that's what worked well for us during COVID, and hopefully will again in the future. But that's what we do.
Okay, and just following along from that, we've got another question here, and this is something we're reading in the headlines, daily. Is are we in an equities bubble right now?
Yeah, look, I tried to address that with the questions earlier, the answer earlier, and look, I'll flick back to the slide just to flag it one more time. If you look at the equity risk premium versus bonds, it would say no. So the overall market is not in a bubble. And so while you may see tendencies of bubbles out there, whether it's the Afterpay share price or the Snowflake share price or some of these EV company share prices, it doesn't necessarily mean that Microsoft or BHP is hugely overvalued here. So the overall market is not in a bubble versus interest rates. The bigger question I think that I'll answer, which wasn't asked in the question, but I'll answer, is our bonds in a bubble? Because if bonds are in a bubble, then we've got a problem. And then if interest rates go up dramatically, then all assets in the world have a problem. And growth equities will not be excluded from that. And so the bond market is the thing we probably watch the closest here, because that is clearly feeding some of this speculation. The overall market is not in a bubble. There is pockets of speculation. We think it's normal, but we don't think we're there yet, because this equation hasn't closed to zero like it did all the way back in 1999, and that's the thing we're monitoring closely. And when it does, we'll probably have a different view.
Okay, and your thoughts, Nick, on China versus Taiwan and the current semiconductor shortages?
Yeah, great question. So this is something we worry about a lot. So Taiwan, if you think of our investments in ASML and TSMC, these are the 2 most important companies in the world. If you haven't heard of them, please Google them, because they effectively create the shrink in semiconductors, and TSMC creates that development of semiconductors. So Moore's law doesn't continue without them. And they all happen. All the technology is either built in Holland with ASML, or sits in the foundry at TSMC on Taiwan, which is this tiny island offshore China that's meant to be neutral. And so from that point of view, if the US continues to clamp down on China's or restrict China's ability to get access to technology, then in theory, they may start moving on Taiwan to get access to that technology. And so this is something we watch very closely also as a sort of a left field event. The people we speak to in Taiwan just say it's normal. They don't think anything's different from before. But we do have this huge concentration of technology now in Taiwan, and so most of human progress really relies on them. So it's really going to be quite an important place in the future.
Okay. Moving on to fintech and payments. We've talked a lot about fintech and payments. Do we see MasterCard and Visa losing their market share, and will they have their Kodak moment?
Good question again. Not in the next 10 years, but in theory it could happen. And so we still like them for this last bit of cash that needs to disappear. And it's important to remember that they have their own B2C businesses, their own peer-to-peer businesses. Even if you're using Apple Pay every day, Apple Pay is actually linked to your credit card. Most people link their PayPal account to their credit card. And so they still have this benefit from all the digitalization still to happen, which will come through. But eventually, you know, if you can solve the wallet issue and you can solve the digital currency issue, and then, you know, they are slightly overcharging for what they offer, then eventually some technology could come along to stop it. And that's something we look at every day. And if I go back to the MasterCard side at the start, you know, why did no one pick up that MasterCard would benefit from this? Because every 2 years they've worried about something coming along that will knock them out of the system. And every 2 years nothing does. And I'm sure people will still speculate, but whatever knocks them out of the system, it's got to get acceptance at effectively 3 million retailers around the world. And you only get that acceptance by walking into 3 million retailers around the world and creating that acceptance. So it's a very hard network to break. But I'm not saying it can't happen. It could, but I don't think it happens in the short term.
Okay. So while we're on stocks, Spotify, what have they got? 350,000 users, and they still haven't made a profit. How many users will it take to generate a profit?
350 million users.
350 million, sorry.
No, I'm joking. Okay. So simply on Spotify, sorry, so we're back to here. These are the areas of interest that we focus on. If we go to internet disruption here, sorry, I clicked on the wrong one. We are looking at this wonderful shift of digital advertising. So the Google, Facebook shift to digital advertising. So you've basically got analog media and digital media. Spotify is just the same thing, right? So it's the same trick that we saw with, you know, Google and digital advertising, that we saw with Netflix and digital video, is now happening to music. And so physical music's going down, streaming music's going up. There will be a streaming winner in the same way that there was a TV streaming winner. It could be Amazon, it could be Apple, it could be someone else, it could be Spotify. At the moment, Spotify is the leader. It has 350 million users, which makes it twice as big as its nearest competitor, and has just under 200 million that actually pay for that subscription. And so from that point of view, this is their market share today versus the other players in the marketplace. And so what we've seen previously with Netflix or with Google or with Facebook, once you've got that leadership position, it's very hard to lose it. But what you have to do when you're holding that leadership position is you have to spend mercilessly to make sure you hold it. And so I used to say this about Netflix 4 or 5 years ago. What's the last thing we want Netflix to do? Pay a dividend, okay? That's the last thing we want them to do, because we know there's only going to be a handful of winners, and we know they have to win. So we know they have to just spend mercilessly to make sure they stay in front, because when they stay to the front, then to the victor goes the spoils. We saw that happen with Google. We saw it happen with Facebook. We saw it happen with Netflix. Spotify's now in that fight. But if you just take a slightly longer term view, if you think about the active users of today, well, this is 240 million, it's closer to 300 million now. You know, there's actually 4 billion smartphones in the world. If you get to 1 billion users at some point in the future, you know, you're looking at 40 billion in revenue. You put that on 6 times sales, which is what Netflix used to trade at, you get a $250 billion company. And it's only a $40 or $50 billion company today. And so from that point of view, what we're doing is we're building a bull, a bear, and a base case. We're probability adjusting it and saying these are the things that we think could happen, and then discounting it back to today. And so from our point of view, whenever we do this, when we did this with Netflix and the others, what generally happens is our best ideas actually far exceed our bull case estimates. And we think Spotify is well set up to do that. It might not turn out that way. They might misexecute. Something might go wrong, someone might go past them, but at least as we look at it today, they look well set up to execute on that. And so it's just a matter of time from here.
Okay. Clean and green, are you looking at hydrogen and any stocks in this universe?
So the answer is yes. Hydrogen is, sorry, I knew I was meant to do something here. Hang on one second. The answer is yes. I think I left the slide in. Or not, no, yeah, there it is. So from that point of view, this is what you have to build in terms of global renewables capacity, be it solar, offshore wind, and at the end comes green hydrogen. So the problem with hydrogen is that it needs a lot of electricity to create it. It's very expensive. You need to build more renewable capacity to fund the hydrogen. So there's no point powering it with other forms of electricity. And so we do like it. We haven't really found anything. We understand how it's going to fit into the mix. We haven't found anything we like to invest in it today just yet. There's lots of speculative stocks, but they all look overvalued to us versus the opportunity. And so from that point of view, it's actually just easier to play it with the renewable energy companies, because all it means is you just need more renewables.
Okay, all right, we're bouncing around here.
Yeah, we're on fire.
Couple more, one or two more questions. Your view on Pinterest as it added 100 million MAU in 2020.
Yeah, so we'll just put our hands up and say we missed that one. We really like it. It would go into our internet disruption area, so it's part of this digital advertising shift. Pinterest moves into digital e-commerce as well. So this is this bust out of your TAM. So you're doing digital advertising, which then moves into digital e-commerce. So you're basically crossing two TAMs. We really like it. We're doing work on it, but we definitely have not. We've missed the first part by far, but at the moment don't own it.
Okay, and your view on Shopify?
Okay, put the hand up again. So these are two that Kieran Moore in our office, in our team here, and Jeremy and James and the whole team have all. We've all tossed them around a few times, but we never got there on Shopify as well. Shopify, love the business, love the founder. Really, the valuation held us back. We had people internally pushing it. We just didn't get there. I think one of the problems Shopify has is a bit like the problem Afterpay has in Australia. Is it's the only good tech company in Canada, so it ends up with a much higher multiple than other companies. And so when we compare it to our other investments, we just found other investments more compelling at the time. And you see a similar thing happen in the Australian market with the good tech stocks that are here.
Okay. Thank you, Nick, for taking the question. Given the favourable macro and pullback, what are your views on precious metals? Have you got a view on gold or silver?
No.
No.
No, look, I mean, I'm sorry. I started my career as a gold analyst. We don't look at it that closely. We don't. Well, we're more open to digital currencies because they may have a use at some point in the future. Gold is just a store of wealth. It's much more a macro call. It's just not really our thing.
Okay. Well, Nick, I think just going through the questions, there's a couple of questions here which are quite long, so I think we might best answer those direct. We'll go back to the clients direct on those ones. I just wanted to again say on behalf of GSFM, thank you, Nick, for taking the time, and thank you everyone on the call for taking the time also to have a listen to what we've got to say today. We will get to each of the states, as I've said a couple of times now, as soon as we can. And we look forward to seeing you all face to face. But once again, thanks for joining, and we look forward to talking with you all soon. Thank you.
Yeah, thanks very much for your time. Echo Steve's comments. Thank you.